let's crack one of the most critical, high-stakes tactical dilemmas you're going to face on the Management Advisory Services Board exam. If you're a BS accountancy student grinding for the LECPA, you already know short-term decision-making isn't just about crunching numbers. It's about seeing right through the illusions examiners love to set up. Today, we're building a mental schema that'll lock this knowledge into your long-term memory for the next 3 years. We're not just memorizing here, we're completely mastering the make or buy outsourcing decision. But before we calculate anything, you've got to ask yourself this fundamental question to avoid those cognitive traps. The true cost? It is not what your accounting system prints out on a traditional absorption costing statement. Actually, scratch that. It's strictly the costs that will change based on your specific decision. If you don't grasp this instantly, you're going to fall for the decoy numbers, and your entire analysis is going out the window. Here's our roadmap to build that mental schema. First, the make or buy dilemma. 2, identifying relevant costs. 3, calculating the cost to make. 4, calculating the cost to buy. 5, the opportunity cost factor. And 6, LECPA hacks and final review. All right, Section 1, the make or buy dilemma. At its absolute core, this decision dictates whether a company controls its own value chain or relies on external suppliers for economies of scale and lower base costs. As outlined in the Garrison text, vertical integration gives a company total control over parts and materials, making them way less dependent on suppliers. But on the flip side, outsourcing allows a company to tap into a supplier's massive economies of scale. Your job on the exam? Figure out exactly which path maximizes the company's financial advantage while completely ignoring all the extra noise. Moving on to Section 2, identifying the relevant costs. Okay, so the ultimate secret hack for the board exam is knowing exactly what to ignore. Your relevant costs are your avoidable costs, meaning the future costs that actually differ between your alternatives. We're talking direct materials, direct labor, variable overhead, and specifically traceable fixed costs, like a supervisor's salary who'd be let go if you just stopped producing. But what do you ignore? Sunk costs. Things like historical equipment depreciation and unavoidable allocated general overhead. These costs stay exactly the same whether you make or buy, so they are practically invisible to your decision. Let's jump into Section 3, calculating the cost to make. So the crucial point here is that your total avoidable cost to make only includes the specific expenses that will literally disappear if you stop production. If a machine is already purchased, its depreciation is a sunk cost. Done. If the factory rent stays exactly the same regardless of what you do, totally irrelevant. You only want the cost that you can physically avoid by outsourcing. Check out how we handled this using the mountain goat cycles case. They give us depreciation of special equipment and allocated general overhead. But notice how we ruthlessly zero out depreciation and allocated overhead to find our true cost of $112,000. If you just took the total cost that standard accounting gives you, you'd be way off. You only add the $48,000 for materials, $32,000 for labor, $8,000 for variable overhead, and that $24,000 supervisor salary because, hey, that supervisor can be let go. Boom, $112,000 is your magic number to beat. Up next is Section 4, calculating the cost to buy. You need to burn this number into your retinas. This is the notorious materials handling charge trap that triggers layered differential calculations, a classic scenario straight out of the review materials. Examiners won't just hand you a simple purchase price. Oh no, they'll tell you that the receiving department applies a variable handling fee to purchase parts. You have to manually apply this receiving department fee to the purchased parts. Think about it. If a vendor quotes you 15,000 pesos and the problem suddenly drops in a 20% variable handling cost on purchases, your true relevant cost instantly jumps to 18,000 pesos. Do not just compare the 15,000 to your make cost. You have got to layer in the handling, the freight, and any purchasing fees. That 3,000 peso difference, that is exactly what separates the top percentiles from the rest on the MAS exam. All right, Section 5, the opportunity cost factor. Opportunity cost is basically the ghost in the machine. It's not a cash outlay, which is exactly why students always forget it, but it is deeply relevant. If you choose to keep making a part, you are giving up the chance to use that factory space for something else. If buying from the outside frees up your factory floor space so you can lease it out for rental income, you absolutely must add that lost income as a penalty to the cost of making. Let's look at mountain goat cycles again. We calculated the avoidable cost to make was $112,000, and the supplier is offering to sell them for $152,000. At first glance, you'd probably say, make it, it's $40,000 cheaper. But wait, What if that freed up space could be used to make a new cross-country bike that generates a $60,000 segment margin? So the crucial takeaway here is that adding that $60,000 opportunity cost to the make side flips the decision entirely. Suddenly, making the part effectively costs you $172,000. And just like that, outsourcing is the clear, unquestionable winner by $20,000. Finally, let's wrap up with Section 6, LECPA hacks, and final review. When you sit down for the LECPA and you see a make or buy problem, do not panic. Just follow this exact four-step logical flow. First, isolate the avoidable make costs and strike a literal line through depreciation and allocated general overhead. Second, calculate the true buy cost by hunting for hidden freight or percentage handling traps. Third, look for any alternative use of facilities and add that opportunity cost to your make column. And finally, compare the two and choose the lower cost. It's a mechanical, foolproof process. Take a mental picture of this checklist right now. Seriously, close your eyes and visualize it. If you lock in these bullet points, you're building the exact framework your brain needs for 3-year retention. You're going to confidently crush any make or buy problem they throw at you because you aren't just memorizing formulas anymore, you are analyzing the behavior of the costs. Avoidable costs rule the game. Sunk costs, they're dead to you. The numbers never lie, but only if you know which ones to look at. This isn't just about passing the LSCP. It's about being the tactical advisor your future company desperately needs. You now have the mental schema to instantly filter the noise, spot the traps, and find the true cost. So, when that exam paper finally lands on your desk, are you ready to spot the traps and make the ultimate call?